Hi and welcome to Swissquote's Daily Market Talk. It's finally Tuesday, November 5th, the day that could bring some clarity to who will be the next US president or not, because the race is too close to call right now and Trump provides ample reasons to believe that we might see a contested outcome when the election results are revealed. So, brace for some volatility in the short run, but don't overthink it for the long term. So yes, ladies and gentlemen, the new week started on a cautious note in Europe and in the US as investors are holding their breath before making their next move after today's US presidential election, which actually looks very, very close to call at this point in time and could eventually result in a tight and even a contested outcome. So yes, the major risk today is not a Harris or a Donald Trump win, but it's the reality that a Harris win could be heavily contested by Mr. Donald Trump and lead to violence and chaos and more uncertainty for investors than necessary and hit their sentiment. So voila, that's the major risk to me today. But apart from that, the fact that Donald Trump and Kamala Harris have different economic and political agendas, very different priorities, and the fact that there are sectors out there that could see a better lift under one or the other presidency may actually not change the overall performance of the long-term stock market and, not even the concerned sectors themselves, like green energy, for example. I'm really thinking about that because, look, I am now going to tell you a fun fact here. Did you know that clean energy outperformed traditional energies by 43% under Trump's presidency? And wait, because traditional energies outpaced clean energies by 53% per year under the Biden presidency. So yes, it's fun to do some brainstorming on rational factors that we have in hand that could move these sectors, but at the end of the day, all of that matters much, much less than what we predict, because you have geopoliticals, you have pandemics, you have a lot of factors that impact prices. And zooming out, a quick glance to the S&P 500's performance a year following a US election has always been positive since 1984, no matter if the US was led by a Republican or a Democrat, except in 2000's technology bubble. And so if you think that we are maybe in a fresh AI bubble that could eventually burst anytime, none of the candidates today could help investors to catch a falling knife. But with that being said, the underlying tech industry changes and it continues to point that the AI craze is not ready to die out just now. Because yesterday saw Nvidia briefly dethrone Apple as the world's most valuable company, as the world's AI darling Nvidia rose on celebration of its inclusion into the Dow Jones Industrial Index effective from November 8th as a replacement to the poor old Intel that was sitting there for the past 20 years. So that switch was clearly perceived as AI's progress within the technology industry and also its increasingly dominant position. And as per Apple, the news that Warren Buffett's Berkshire Hathaway reduced its holding by 25%, guys, it didn't help boost appetite among investors. But hey, Apple remains the firm's biggest holding still, as Warren Buffett's team apparently prefers to sit on a colossal amount of cash today, probably put off by high market valuations of the moment. So Warren Buffett prefers cash to anything, and that's Apple included. And speaking of valuations, the S&P 500 kicked off the week on a slightly negative note, as I said before, but near an all-time high level still, as it is the case for the Nasdaq 100 and the Dow Jones Industrial Index. As per the yields, the US yields fell and the US dollar was hit by a wave of realism that the gap between Kamala Harris and Donald Trump was much, much tighter than what the prediction markets and what the broader markets have been pricing in over the past few weeks. So the latter gives you a slight opinion, an idea about the type of relief rally that we could see in case Kamala Harris wins the election and Donald Trump accepts it. As such, the euro dollar, which is seen as one of the most vulnerable major currencies out there to a potential Donald Trump victory due to a tariff threat on the European Union, is consolidating a touch below the 109 level at the time I'm talking here. A Harris win could send the pair above the 110 psychological mark, but a Donald Trump win or a contested outcome could move capital back to the US dollar. Because remember, analysts at Goldman Sachs think that the euro could lose up to 10% against the US dollar if Donald Trump returns to the White House. And well, in case of a chaotic election day and a contested election outcome, gold and Swiss franc would be my go-to places to let the dust settle a little bit before coming back to the riskier pockets of the market. Now, elsewhere, the Reserve Bank of Australia maintained its policy rate unchanged at a 13-year high today and said that headline inflation has sure declined, but that the underlying inflation, which is near 3.5% level, remains too high still to make that decision to cut the interest rates. They certainly don't have the same approach than their Federal Reserve colleagues, who see the core inflation in the US remain near 3%, but who simply made that bold step of cutting their interest rates by 50 basis points last month, and who are still expected to continue to cut the rates by 25 basis points again this week. As such, the Aussie dollar rebounded on the back of the divergent Fed and RBA policy outlook. The Aussie probably got a boost from some good news from China as well, its largest trading partner, as the Caixin's PMI index showed a stronger than expected rebound in activity in October. The services activity also supported by a rebound in factory output in China. And to top it all off, news that China is now considering a plan to lift the local government's debt ceiling and to shift some of their hidden unofficial debt onto their formal and official financial statements to reduce financial burden on these local governments and give more transparency to this financial picture. Also helped lifting the mood because the CSI 300 is up by more than 2% this morning, and couple futures are gaining momentum to the upside as well. So is this time the charm? Maybe, but enthusiasm over China was not enough to further boost oil prices this morning. The barrel of US crude is slightly lower at the time I'm talking here, near $71.50 per barrel level, after having jumped more than 3% on Monday's trading session on news that OPEC is considering to delay its output increase by a month or maybe more than that. And also rumors that the tensions between Iran and Israel could rise again should also provide some support to the short-term tactical bulls in oil prices above the 50-day moving average near $71.30 per barrel level and above the critical $70 per barrel psychological level. But oil bulls need a robust Chinese recovery and perhaps a longer restriction output plan from OPEC as well to win over the medium-term bears. As such, the key resistance to the actual bearish trend that is supported by the Chinese and global demand weakness and ample global supply stands at $72.85 per barrel level, which is the major 38.2% Fibonacci retracement to the July to September sell-off. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please do not forget to hit the like button on these videos to let us know day after day that you enjoy them. So I will see you again tomorrow after the US election. And until then, good day trading.